Well, hey, everyone. Welcome back. Another great episode today. Again, zooming in with us, Mr. Felix Vortsman, who is a rockstar real estate coach. He is the Triplex Conversion King, if I'm not mistaken. He's the guy that kind of got that all figured out. And that's what we talked about on our last conversation, Felix, was your whole process of turning a single family home into a duplex, or more, even better yet, a triplex, especially in Ontario. That's one of the few ways to make them cash flow. But today we're going to be talking about the capital side of things, because Felix has been working with joint venture partners and raising capital and working with investors since 2013. And over the last couple of years, he's gotten involved in projects and deals in developments south of the border in the US. And he's been raising capital for those projects. So I'm very, very interested in finding out how you've gone about doing that and how things are structured and how they work, that sort of things. Felix?
There are millions of real estate investors out there, and most are stuck with just a couple of properties. They want financial freedom, but their small portfolio ends up costing them more in time, effort, and money than it's worth. Getting out of the rat race seems harder than ever. This show will help you do more deals, better deals, and bigger deals. Finally, you'll be able to reach your income and lifestyle goals. How? By attracting and leveraging private money partners and their capital. Now get ready to raise more money, because here's your host, Dave Dubeau.
Welcome back to the show.
Thank you for having me back.
All right, my friend. So when it comes to the capital side of things, can you walk us through a little bit about your journey there? What was your memory of your first joint venture partnership, and where has that gone today?
For sure. Well, just like any intermediate or advanced real estate investor, we hit one of two brick walls. Typically, it's either access to capital or access to credit, or both. So if I wanted to continue, with my real estate investment endeavors, I had a proven track record. Tested a lot of these strategies on myself. I felt that it was time to bring in other partners so that I could continue doing what I was doing.
Yeah.
Started off even something simple like a buy and hold property, essentially. Could no longer, either didn't have capital or didn't have credit, essentially, to keep actually more capital at that stage.
Yeah.
I find that capital kind of works itself out over time. And I feel that it's more your access to credit that is more important. As long as you have access to credit, you will get capital over time. But eventually, after a certain number of properties, depending on what strategy you undertake, eventually even, that pares down over time as well, right?
Mm-hmm.
A lot of diminishing returns. So that kind of got me into larger deals where, the financial institutions are no longer looking at myself or even my JV partners, but more on the actual buildings themselves. In the multifamily space, for example, right? Different type of commercial financing rules there. Banks are more focused on the performance of the assets significantly more than, any collateral that you're providing.
Mm-hmm.
So that kind of got me to transition out of the smaller JV type of arrangements into bigger syndicated private equity deals on both the development side and the multifamily side, both in Canada and in the US.
Okay, very cool. All right. So for folks who aren't familiar with what that means, can you give your definition of a syndication or a syndicated private? Did you say syndicated private deal or syndicated development deal?
They're all private, syndicated private deals.
Okay.
Depending on, but then you decide which strategy you want to undertake. Do you want to invest or participate in a development deal or a multifamily deal? Actually, the whole world of opportunities kind of opens up to you with the syndication model. So a syndication model basically is, you have a group of investors that collectively put their funds together in order to purchase a larger asset that
Mm-hmm.
you individually may or may not be able to purchase yourself, or it's a way for, and even if you can purchase that asset yourself, it enables you to diversify your portfolio, spread amongst several different deals and strategies, as opposed to basically just dealing with one specific property, right? So we're talking about assets that are about, $15 to $50 million,
Mm-hmm.
right? sometimes even larger than that. Typically, they're available to accredited investors on the passive side, the limited partnership side. Typically, the way that these things work is you typically create one of two structures, either a GP-LP structure or a fund structure. And that comes with its own pros and cons, each one of those structures. There's other structures you can undertake. I mean, the whole world is open to you, but it really depends on how many. If you have a lot of investors, those typically are the ones that kind of bode well.
Yeah. So how did you get started in this whole space? Because it's a big jump going from onesie twosie JV partners on a single family home to starting to syndicate these much larger type properties. So what's been your learning curve there, Felix? How did that progression happen?
Well, I mean, I started investing in single family homes, then I basically started expanding into these duplexes, triplexes. So to me, it's just a natural progression as an investor. But ultimately, if you want to achieve economies of scale and truly, maintain you want to maintain like a passive investment, those really bode well, because now there's enough economies of scale for you to hire professional property management, project management. So as long as you build those teams in place, you can truly make this quite passive, especially on the limited partnership side and even on the general partner side. As long as you have a great team in place, the amount of time that's really required of you is not really a heck of a lot. So it's basically bodes well to most people's desire to invest in real estate. Most of them don't want to invest in real estate just for the sake of investing in real estate. It's the why, right? And the why typically is time freedom, right?
Yeah, of course.
Or financial freedom, right? So this bodes really well for individuals looking to generate great returns, possibly great cash flow as well, while giving you that time freedom that most people desire.
So maybe walk us through an example of a deal that you've done in Canada, a syndicated type deal that you've done in Canada. Big broad strokes, if you don't mind sharing, like where was the property, how many units, give or take, what was the purchase price, how much capital did you have to raise, how did you structure it, how many partners, that kind of stuff. If you happen to remember that. It's a lot of details. But
so it doesn't matter whether it's in Canada or the US. Now in Canada, I haven't raised funds in Canada. I'm participating on several development deals, multi-phase subdivisions all across Southern Ontario. And I'm also a partner, actually in that situation, it's a JV partner in a 94 unit building in Kingston, Ontario. But pretty much invested in thousands of development units, on the limited partnership side. On the actively managed side, more focused on the U.S. market right now.
Okay, well then let's talk about the U.S. because that's something a lot of people are interested in. Canadians are looking south of the border, see a lot more opportunity, a lot better prices, a lot better, cash flow, et cetera, et cetera. So, maybe walk us through an example of something you've done or you're working on right now.
Sure. I'll give you a recent example. We closed on a 122 unit all townhouse complex in Decatur, Georgia, which is in the greater Atlanta area of Georgia. That asset we purchased for $18.2 million. The raise was around $8.2 million. So that's what we needed to raise from investors for both the down payment, the CapEx, capital expenditure budget, contingency funding, all that good jazz. We decided to raise funds both in the US and Canada. So we actually have co-general partners in both US and Canada. Basically, in order to raise those funds, came down to leveraging off of our networks of other investors and other players in the marketplace. It really comes down to people's, short-term objectives, long-term goals, right? So
Felix, from a practical standpoint, your co-GPs in this project. So maybe give us an idea of who the other team members are, how many of you are there, kind of who does what, who's responsible for what in this situation?
For sure. So initially, when you're looking at these deals, some of us actually source the opportunities. Others, set up the A-level teams in place in order to execute on our business plans. And collectively, on a month, on a weekly, and I'm talking from the standpoint of as a co-general partner.
Yeah.
Initially, in order to close on the property, you're looking at financing, you're looking at doing your due diligence, so we've kind of divided and conquered from that perspective.
Yeah. So how many people are there altogether in the co-GP team in this?
So in this specific opportunity, I believe there's about 8. Okay. However, there's a main general partner that's local, and they have been executing on these types of strategies for well over 12 years. The nice thing about dealing with individuals such as that is we can forego a lot of the challenges that new entrants into the marketplace have to deal with, building those relationships with the real estate brokers, building those relationships.
Yeah, they're the local boots on the ground kind of.
Correct.
They know the market. They know everybody there. Yeah, for sure.
And we can leverage off of their A-level team of professionals as well, property managers, project managers, and whatnot, right? So, and the nice thing is, I mean, they have boots on the ground. Worst case scenario, they can actually go out and see that property at any given point in time.
So was that the person who found the deal? Is that the person that brought the deal to the table? No. Okay, cool.
This is actually the second opportunity we're dealing with this individual, and sometimes they invest their own funds in it. As a general rule of thumb, we actually eat our own lunch, practice what we preach. So we actually participate on both ends. We put our own money where our mouth is. We invest in these projects ourselves. So we participate as both general partners and limited partners on these type of opportunities. Clearly builds a heck of a lot more trust with our investors if we're putting our own money where our mouth is.
Yeah, you got your own skin in the game. So you got 8 people on this team. You got the main general partner, that's the local guy, yourself. We're not looking for names here, but the other team members, kind of what do they bring to the table?
A lot of them have expertise in dealing with in the multifamily space, either themselves or through other deals, raising capital. Bringing in the expertise from an operational perspective, a financial perspective. We have an appraiser, for example, that works on one of the big 5 banks in Canada. So he did a lot of the underwriting work. All of us were basically focused on raising funds. And you'd be very surprised at how small the world is when it comes down to raising funds. Even if you're crossing the border, we were kind of bumping heads with people that each of us collectively kind of knew.
Yeah.
So, and that I found that to be really fascinating. Some of us were raising funds in the U.S., from their network. Others were, like myself, were raising funds in Canada. So
just out of curiosity, how does that work? Big broad strokes logistically for a Canadian to invest their funds in an American deal, like in this kind of a situation.
So this comes down to what structure you decide to undertake. And, like I said, as I alluded to previously, you could do a GPLP structure typically. And typically the asset is owned by an LLC, limited LLC structure in the US. And then the LLC in turn is owned by the GPLP. Now, the reason why you want to do this as a Canadian is because CRA does not recognize the LLC structure. Yeah. And as a result of that, you would expose yourself to potentially double taxation. And we have a foreign tax credit available. We have a tax treaty in the US. So if you structure these deals properly, and tax effect is the same as if these properties were located here in Canada.
Right. But that's the big key, is you got to structure things properly. I've heard over and over again, Canadians kind of screwing up because they go down, not these big type deals, but they go down to the States and they buy a property and they set it up in an LLC like they're told to in the States, because that's how Americans could do it, because the IRS does recognize the flow through, ability of an LLC, but Canada, in all its wisdom, that doesn't exist for us. So the CRA can't figure out how to make that work. Absolutely. Yeah. Okay, cool. So you got the GPLP.
So as part of that, maybe if I can elaborate a little bit more. As part of that, it's imperative to deal with the proper securities lawyers, cross-border accountants, cross-border lawyers to ensure that structure is set up properly. I cannot underscore this enough. It's not something that I would recommend people doing on their own. So
no, and I would imagine, Felix, that it's quite a significant expense to get all of that set up for a deal this size.
That's correct. However, that's also the reason why we're dealing with larger properties and larger opportunities where it's worth our while to pay that level of for that level of expertise, right? I mean, like it wouldn't make any sense for, let's say, a single family home. You know, you're paying through the roof for something like that. So, but if you're dealing with a $20-30 million property, sure, you know, it's, you know, in the grand scheme of things, it's peanuts.
And it's a drop in the bucket. Exactly.
Correct.
Yeah. Okay. So I'm still trying to get my head around this. So your Canadian investors, are they investing just liquid cash? Are they able to put their RSPs into this kind of deal? How does that work?
No, great question. This comes down to, again, the structure you choose to undertake.
So the example that you're sharing with us right now.
So the example that I'm sharing right now is a pure GP-LP structure. The other more common one is a fund structure, a closed fund structure. To give your listeners a bit of like the lay of the land between the difference between the two, a GP-LP structure, you're looking at a specific asset, one specific property. A fund structure will have a basket, potentially a basket of these properties inside the fund structure. The pros with a GP-LP structure is we tend to run these type of strategies very lean. So you don't have like a bunch of overhead, CEOs, CFOs, admin staff, or anything like that. Whereas with the fund structure, yeah, you need the fund administrator, you need all that overhead. And the negative part about the fund structure is your returns obviously take a hit as a result of that additional overhead. Whereas with the GP-LP structure, you know, I'll give you just for sake of argument or clarity, our recent deal, our expected internal rate of return was 16% internal rate of return. If we were to basically convert it into a fund structure, that return would get cut in half.
Wow.
Right?
That's a big hit, but I get it. Right.
Right. Well, and the reason being is because when we raise funds, we already have a deal in play under the GP-LP structure. With a fund structure, you're raising funds before you might have any properties in place, but
you still have to be paying out.
Correct. So there's reasons for that. So you're undertaking significantly higher risks. However, so yes, the profitability is better. You also, under the GP-LP structure, required to file U.S. tax returns. But as I mentioned before, we have a tax treaty with the U.S., so it's kind of a wash. So people need to take into consideration the cost of filing a U.S. tax return. And of course, we have cross-border accountants here in Canada, so you can certainly do this in Canada, open up U.S. bank accounts in Canada as well, based accounts as well. So all of that stuff you can do locally. But with the fund structure, the problem with the GP-LP structure is typically you cannot raise funds using RSP and TFSA funds.
Right.
Whereas with a fund structure, you can, if structured properly. Right. So you have your pros and cons, right? Maybe lower returns, but yes, I could possibly use my TFSA RSP funds under the fund structure, or I can go with higher. And by the way, you may not even need to require to file a U.S. tax return with a fund structure either. Right. So pick your poison.
Yeah.
But regardless, typically you would have to still, you know, if you were looking to passively invest in these deals as a limited partner, typically you'd want to make sure that you're an accredited investor, qualifies as an accredited investor. We, as the general partners, want to make sure that we're on the right side of the regulators, right? Very, very important. The penalties and fees, if you don't do things properly, are obscene.
Yeah.
And if for whatever reason people cannot get involved as an accredited investor, then there's other ways for them to get involved and be part of these deals, but be on the active side of the deal.
Okay.
Right? So
be part of the be one of the co-GPs, basically, is what you're saying. Yeah.
Correct.
Bring some value, bring money, plus bring value to the table. That way you can,
And on top of that, I mean, if you're just cutting your teeth in it, it gives you a great, you know, opportunity to actually learn the ropes, cut your teeth in these type of deals, and have all these great mentors to kind of coach you along, right? And build these relationships.
Now, with that in mind, how open are people to bringing on newbie co-GPs?
It varies. I mean, honestly, all of us, as you're well aware, the critical success factor to making any of these deals happen is we need to raise sufficient funds. So one of the biggest values that you could provide as a potential co-GP is become a capital raiser.
But that, if I understand correctly, and correct me if I'm wrong, Felix, that cannot be your only role in the project, if I understand correctly.
It can be. So there's a distinguishment between co-general partners and sponsors. Sponsors can just raise funds and get compensated potentially, possibly.
But don't they have to be licensed or something
Not
like that?
necessarily.
Okay.
Again, as long as they basically follow the rules with accredited investors and whatnot. Remember, they're raising funds with accredited investors. And of course, as sponsors, near the tail end of that, we will get involved with their leads as well, make sure to answer any questions they may have. At the end of the day, we want to make sure it's a win-win situation and it's the right opportunity for people, right? For some people, it might not make sense. So we want to make sure that people fully understand, what they're getting into, what their expectations are, and go forward with that. So it's just a way to maybe get your foot in the door as a sponsor potentially, and then you can work your way up to become a co-general partner. But yes, it's imperative to stay on the right side of the regulators, regardless.
All right. So let's talk a little bit about that. Thank you very much for explaining how you guys have done that. I really appreciate that. And I think that's great value for our listeners as well. Now, when it actually comes to the capital raising side of things, there were 8 of you involved in this. You said everybody kind of pitched in to help raise money for the deal. How do you, in that situation, you've got 8 partners who are the management team, the co-GPs. I don't know about this situation, but life in general, there's usually 1 or 2 people really working hard and a few that are doing a decent job and a few that are slackers. It's life outside of this perhaps, but how do you determine what percentage ownership? How do you divvy that up?
Well, initially is based on the number of funds you raise.
Well, there you go. That's fair. So if you don't raise any capital,
you get nothing
besides whatever you put in, that you're a limited partner and you get very little extra there. And the more you raise, the bigger the piece of the pie.
Initially, right? I mean, there's other considerations. Obviously, you want to have the expertise there. So maybe the person raising the most funds may not be the most experienced from an operational perspective, right? So
yeah, probably not. Yeah. Okay.
And it's just like any other JV opportunity, right? You want to basically do your due diligence with the people you're getting in bed with, right?
So for example, you're saying the gentleman that you're working with in Georgia, your main GP, the guy with the boots on the ground, maybe I misheard that, but it kind of sounds like maybe he's got a bigger piece of the pie because he's doing more, or
well, not necessarily doing more. He's actually pretty hands off.
Okay.
After we took possession of the property, he's relatively hands off, but he did provide substantial at-risk capital. Remember, just like any other purchase that we make here, you make an offer on a property, you have to provide a deposit. If you fail to close on that property, guess what? Your deposit disappears. So, and you're dealing with an asset that's, $18.2 million.
Yeah, the deposits, the deposits significant.
Correct. Right. So
what was the deposit on that one? Just for
it was staggered, but it was about $1 million.
Yeah, basically. I would think so. Okay.
At-risk capital, effectively. And remember, I mean, like if the deal doesn't close, our limited partners are not on the hook there, right? So the nice thing about being limited partners is limited liability. Their liability is limited to whatever investment they made, and nothing more and nothing less.
Right.
We've never had that happen before, but at least that's one of the securities, right? Whereas the general partners are exposed to all types of liability, right? And start right from the get-go that at-risk deposit. So if we were to fail at closing that deal, somebody's going to be taking a major hit.
Right.
So our main partner was more involved in the deal, as far as, getting the financing involved, dealing with multiple lenders that he's had relationships with, and navigating that. After the closing, the other co-general partners came in, and in addition to raising funds, and we're actually very active on the operational side of things.
Got it. So it's a little bit front end loaded for your main guy there, and then now it's much less.
Yes, but he has to of course guarantee the mortgage too, right?
What's that?
Somebody has to guarantee personally guarantee.
There you go. So he came up with the deposit, and he's the guy on the mortgage. All right, that's significant. So
he's getting a bigger
deserves
chunk of the pie.
That deserves a good chunk of the pie. That's for sure.
Right.
Yeah. Cool, Felix. So okay, So you've got the 8 of you, you've got different percentages, give or take in this particular deal. What percentage ownership of the asset does the general partner group have versus your limited partners, your investors?
Wow, that's a loaded question. So each one of these deals, and I cannot impress this enough to your listeners.
Mhm.
It is imperative to do proper due diligence on a project by project, investment by investment basis, because not all of these deals are created equal. We all have very different underwriting, deal underwriting theses and the ways that we do things.
Yep.
We tend to take an overly conservative approach, right? I've seen deals cross my desk that are overly liberal with rental rates went up by 20% last year. Let's extrapolate for 5 years that they're going to go up by 20%. That's just lunacy, right? Or cap rates are 4.5%. Let's basically assume that by the time we exit, it's going to be 3.5 or 4%, right? We don't do any of that stuff. We actually take the total opposite approach. We actually, in our deal underwriting, we actually increase cap rates on a yearly basis, right? The internal rate of return that we're offering is also very conservative. And some of these deals may have a cash flow component, some of them may not. Ours does. We have a preferred 8% cumulative yield as part of that 16%, although it's not going to be like a private mortgage. You're not going to get paid on a monthly basis. They are quarterly distributions, but they could be up and down like a roller coaster. But because they are preferred, they are owed to you from day one. And that 8% is payable to you before the general partners can participate in any of that. More importantly, what is the split between the general partners and the limited partners? I've seen deals as low as 75% to the general partners, 25% to the limited partners. That's just nuts. More common is 50-50, but be careful. Sometimes your general partners might not have zero skin in the game. So be wary about that if they can't put their money where their mouth is. Ours is about 70-30 split. And our nearest competitor that is operating out of the West Coast, actually where you're from, BC, they're investing in the same areas. They offer a 65-35 split in favor of the limited partners. We offer a 30-70. However, the difference between us and them is we actually offer cash flow. They don't.
Right.
So, right. And really it comes down to building long-term relationships with our investors to create those win-win situations. We're willing to give up some of the profits, some of the share of the piece of the pie that we own as general partners, in exchange for building those long-term relationships, right? So if we can,
it's got to make sense for your investors, or they're not going to do the deal. I mean, that's
absolutely
that's the bottom line. Okay, very cool, Felix. That is great. Now that you've gotten into the syndication side of things and raising capital on a bigger level, even though that's not all on your plate, like not everybody's looking at Felix to raise all the money for these kind of deals. But what have you learned besides the fact that it's a small world and you're approaching people that your partners are approaching as well? What have been some of your learnings from this whole process so far?
Well, for those that qualify with accredited investor status, there's a new world of opportunities that most people never even thought existed. And you can basically participate in those type of opportunities and diversify your asset base across geographies, across countries.
So are you finding that a lot of accredited investors might not realize that they are accredited investors and have this opportunity? Is that what I'm hearing?
Correct.
Okay. So your step number one is actually educating people that they might qualify for these kind of opportunities. So what are you doing to find these accredited investors, or sift, sort, and filter through your connections to figure out who might qualify and who doesn't?
Without getting into the specifics of basically, how to qualify for accreditation status, normally higher earners, like in the professions of like doctors, dentists, that sort of stuff, they have money to invest, but they don't necessarily have the time to do so. So they are looking to generate a great return, but they don't want to basically be active at all. They want to be passive in nature.
And that's
right?
your perfect LP.
Yeah,
that's who you're looking for. But don't you find that everybody's going after these guys? Isn't there a lot of competition for their attention and trying to?
Well, the biggest competitor to us is actually the major financial planning organizations.
Yeah.
right? And the problem is, if you're looking at financial planners, for example, very few of them ever offer syndicated private equity deals to their investors. There's nothing in it for them most of
Exactly.
the
So
time.
why would they?
Correct. And if you're looking for stability of returns with a hard asset, without having to depend on CEOs, CFOs, major corporations, all that good stuff. I mean, at the end of the day, where are we operating? What field do we operate in? We operate in a field of offering a basic human need, right?
No, I get it. You're preaching to the choir here, Felix, for
Right.
sure. It's just I'm asking, how are you getting these accredited investors to pay attention to you? How are you getting them engaged? How are you getting them enrolled in these kind of deals?
For sure. Well, initially, I mean, I started off obviously with my own network of clients that have grown with me through, hands-on real estate investing strategies.
Yeah. So you got a pretty good guess of if they would qualify or not, just based on
Correct.
your personal relationship. Got it.
That's right. And and the great thing is, I mean, they've done really well, just as I have with real estate investing. And then basically friends and family. Then you have you're looking at maybe organizations such as OMA, Ontario Medical Association, Dental Association, all that good stuff. I'm not saying that that's exclusive. I mean, basically anybody who's high net worth, because you can qualify based on income or net worth, right? Net worth. So if you have $1 million in liquid assets, you would qualify as an accredited investor, not including real estate. If you have $500,000 net worth, including real estate, you would again qualify as an accredited investor. Or if you have $200,000 individually or $300,000
in income,
again, you would qualify as an accredited investor. It's not for everyone, obviously, right? Clearly, not everyone would be able to qualify, but for those that do, it's certainly a great way for them to diversify their portfolios, get great returns. And most of the people are not even aware that these type of opportunities exist because their financial planners are not.
So are you just kind of reaching out to these people cold and starting the conversation, or what have you found has worked well for you for bringing investors on board for these deals?
All of the above, really.
Yeah.
Usually have these conversations, do I know, reach out to my network, find out if they know of somebody who would be interested in something like this, or somebody who has expressed interest in real estate investing, but doesn't want to really do it very actively, but is still looking to generate a great return. At the end of the day, it's creating win-win scenarios, right? I should be, I guess, there's other ways to do it. I mean, you can do it online, but it's, the hit rate with respect to people that you're going to be attracting, it's more complex to discuss on an online basis. You definitely need them to basically have a phone call with you so that they can have the opportunity to ask you questions, so you can convey that knowledge that they need in order to make an informed decision at the end of the day, because it's not going to be for everyone. Right. So what else do we do in order to basically access investments?
So do you guys, are you consistently reaching out to people between deals, or is this kind of like you got a deal on the go and it's hustle, 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 and then next deal comes along, hustle, hustle, hustle? Or have you created a database of investor prospects? Are you doing a drip campaign with marketing to them, all that kind of good stuff? Are you?
Absolutely. I mean, we do have that database. I mean, maybe if I can impress, depending on how many deals you want to do in any given year, the reality is it is much tougher to find a new investor than to have an investor that has been ecstatic with the results that you've been providing them, for them to reinvest with you as well. So based on some of the other organizations I deal with, and of course they have the same challenges as we do with respect to raising funds, as long as you have that database of, a couple of hundred investors, right, you can make deals happen. Because there's going to be people that will only basically invest the bare bones minimum, but there's also going to be larger investors that are willing to put up $1 million, $2 million in any given.
What is typically the bare bones minimum for these kind of deals? Varies.
I mean, the ones that I participated in, both as an active partner and a limited partner, anywhere as low as $25,000 here in Canada, to up to $300,000. It really depends. As a minimum, the GPs basically decide the minimum threshold, but maybe if I can impress, why that is, we're not in the business to deal with thousands of investors, so we can't make that threshold $500. Just the paperwork alone will cost us well more than that.
You want to deal with accredited investors, so these people theoretically should have some capital
Right.
available, right?
And we want to make sure that we can, answer everybody, our limited partners' questions and be able to be available to them anytime they need to answer those questions. So if you have thousands of people that you have to reply to, it's, it takes away
full-time
from our
gig.
ability to execute on our business plan, because now it's a full-time job, right? So that's why there's that threshold typically. Normally it's anywhere between 50 to 100,000 as a minimum, both in Canada and the US. As an entry point. But as I mentioned, most people who deal in this space, what I've found is there's going to be a couple of big whales that like to invest lots, way above the minimum. And then you'll have a sprinkling of, 50,000, 75,000, 100,000, maybe a couple of 100,000, but the bigger guys are basically, funding a good chunk of that deal. And one of the bigger guys is obviously us as the general partners. We believe in our deals, so we put our money where our mouth is. So I'd probably say 15 to 20% of all the funding came from us.
Okay, well, that's good. Yeah,
right.
You definitely put your money where your mouth is. Well, Felix, this is great. Thank you very much for sharing your experience with this. I think it's going to be very, very helpful for a lot of our listeners, both in the U.S. and Canada, because it applies both ways, that's for sure. So if people want to connect with you, what should they do?
They can connect with me either on Facebook, LinkedIn, or they can email me at Felix, Felix, at cloud, CLOUD, the number 9, life.ca. Felix at cloud9life.ca.
I like that URL, cloud9life.ca. That's a good one, man. Good job.
Okay.
Felix, it's always a pleasure. Thank you so much for being on the show.
Pleasure was mine, David.
All right, everybody, take care, and we'll talk to you on the next episode. This episode is brought to you by moneypartnerformula.com. Our Money Partner Formula service allows you to raise all the private capital you need to do all the deals you want while we handle the hard stuff. We offer reliable and affordable done-for-you marketing services that get you investor meetings booked without all the work. So go ahead and check out the website right now, and then feel free to schedule a call with me, and let's take your portfolio to the next level. Again, that's moneypartnerformula.com. Watch investor meetings pop up in your calendar. We handle the rest.